Welcome back. Today, we're exploring how Next Funding revolutionizes the way we invest in innovation. Greg, welcome.
Thanks, Danny.
Another episode that we did, we mentioned about Next Funds and budgets. Basically, the way we build budgets is made for a performance system, but not to move things forward in an innovation system. So, how should we do it to actually make investment in innovation work on an innovation system?
Yeah, I think that was in the Fantastic Five episode. We were talking about that important fifth element of funding and establishing a new approach to funding for your next system, for your innovation system. And it's sort of understandable why most organizations have the wrong funding mechanism in place. If all you have articulated for funding is the budget process of now an organization, a performance system, we know it's an annual budget process, right? Groups get together, they talk about what they're going to do the next year, they put their budgets together, they submit them for approval, they get something granted, either more or less or the same, and that's what they've got. And that works when you have a lot of certainty. But when you're dealing with a lot of uncertainty, that model is, if you just look at it a little bit closely, you can see that it doesn't work. And so let's think about, for a second, a next funding approach. Let's take an example of a grow portfolio. So I've got a grow portfolio. I have 50 innovation opportunities in that portfolio. If I have 50 of those, and they're at the formulate stage, the very early stage, where we just want to check and see, okay, is there vision fit, purpose fit? Is it consistent with our goals and our strategy? We then want to go and validate that, yeah, we've got some ideas, we got some of need. We think that there's an innovation opportunity, but we're going to go validate that in the market. We're going to go have some conversations, some open-ended interviews, do some observation, and see, do we think that the opportunity is significant enough to invest in? So if we took our budget and we divided it by 50 and gave them to each of those, then we would have some teams who spent a lot too early and only to get to a no, that there's not an opportunity here and we shouldn't move it forward. So what you really want to do is you want to create a more scalable and flexible approach. And the model isn't a new model. It's used frequently. It's actually a funding model that you would see in either corporate venturing or in venture capital. And that is, essentially, you raise a fund inside your organization. You say, we're going to set aside a certain amount of financial capital that we're going to invest in our next, right? Mm-hmm. It could also be we're going to set aside a certain amount of our human capital that we're going to invest in our next. Or we're going to allow some intellectual capital to be invested here rather than in other places. Or we're going to expend some political capital. And so you're raising a fund, you're looking at the different dimensions of that fund, and you're going to say, we're going to release small amounts of that fund as each opportunity earns a right to move forward. Okay. So if we use that next decision-making criteria and the opportunity gets to a no, then we can stop it. And when stopping it, we're protecting capital, right? We're saying we're not going to unnecessarily expend capital. Let me just give you an example. So we do some work with the United States Air Force. Mm-hmm. We happen to work with an innovation hub at the Air Force. And they shared with us a story early on in our relationship where they had a need, which was they needed to develop a rescue package. This is a package that could be dropped into a kinetic warfare environment. Kinetic meaning people are shooting at each other and blowing things up. Okay. And they needed to help the troops on the ground get out. Mm-hmm. So they were able to drop this rescue package out of the back of an aircraft, which would allow for the troops on the ground to identify where they are and to make strategic decisions how to avoid further harm, mm-hmm. and how to position themselves for extraction. And they had a team who had a fantastic concept for what this package would be. And they said for the first prototype, it was going to be $1.5 million. So they essentially wrote a check to that team for $1.5 million. And what they didn't do was they didn't ask the team to meet a minimum threshold, which was to say, the package had a requirement. It had to be delivered in a particular kind of aircraft, the C-130 transport plane. Mm-hmm. And that was a requirement. Like, we need this package that you developed to do that. Mm-hmm. So the team came up with a package. They spent $1.5 million building something, and then they tried to put it on the back of a C-130 transport plane. And guess what?
What happened?
Didn't fit.
No,
right?
Really? After 1 million?
Too big.
No.
Yeah. So, I think in the military context, $1.5 million isn't a lot of money, but really they could have invested probably $1,500 to buy some cardboard and some styrofoam or foam core, build a model at scale, and then say, prove to us that you've envisioned something at scale that's going to meet this basic requirement, that it fits in this aircraft. So that's an example of they released too much money too soon. Yeah. They funded it like a project that was going to go to completion instead of an innovation opportunity exploration driven by experimentation, where it was going to meet certain thresholds, and then once it met that threshold, release another small amount. Interestingly enough, like in the formulate stage, it doesn't usually cost a team more than $1,500 to $2,500 to validate if an innovation opportunity is real or not. Mm-hmm. So I think that the underlying principle here really is, how do you control the flow of funding in order to allow a team to make progress and to demonstrate that the opportunity is worth continuing with or should be stopped, and those teams that get to stop should be celebrated, again, because they're preserving capital. So I think that's this is sort of in broad strokes what we're trying to do there.
And does this has any relationship with this Super 7 that you mentioned, the criteria to move a project forward? Sure.
So at every stage of the next cycle, there's a Super 7 check-in, and the Super 7 asks these 7 basic questions, right? The first question is there a strategic fit? Right? Does it fit our strategy as an organization? Is our portfolio fit? Do we have too many teams already working on this, or do we have white space? Can we afford to do another one, or do one in the first place? Or should we be doing it because it fits in our portfolio? Then, is it wanted? Is there actually a need? And is that need big enough to warrant doing something? Is it actually doable? Do we have the technical know-how? Do we have the political permission? Do we have the cultural permission? Do we have the skill set and knowledge required to do it? And then, is it worth it? Is it going to produce the kind of capital? Are we confident it will produce the kind of capital that we want it to produce? And then the 6th and 7th questions are, does the next stage represent affordable loss? So this connects directly to funding, right? So, okay, great. We're meeting these criteria, but the next stage is too expensive.
Okay.
So they're a great example of Google and what was Google X and their other bets area where they were working on airships. They were very excited about airships. And they got to a point where the next stage of development was going to require that the airship itself be built. They needed a working prototype at scale. Mm-hmm. And that was going to cost $200 million. And they said, not worth it for us. That's too much financial capital to get to the next step. So we're going to close it down. So what they said is, it's not a good fit for us. Simultaneously, we had a client in the Air Force who acquired a blimp factory in North Carolina for $150 million. And for them, $150 million was not significant. Yeah. It didn't represent too much capital to get to the stage where they could build an operable airship. So again, it depends on your organization and how you weight the capital and what's important to you. But definitely there's that 6th question of, does this next stage represent affordable loss? And then also connected to the financial piece would be, in terms of funding, is it producing option value? So does this innovation opportunity have potential to produce option value? Which means I'm willing to invest in it, even if the capital contribution doesn't seem significant enough yet. We think it gives us some value in terms of how quickly we can go to market, how slowly we can go to market, at what scale we can go to market. Is it flexible in the sense that we could use this for other things? And do we think that if we decide to stop, that we could exit it and capture some value on exit? So those are other considerations in the budgeting. Mm-hmm. And the budgeting is actually a fund and an investment. It's not budgeting, right? So it's like, we've established a fund. We're gonna now put some money into this thing. We're gonna let it get to the next stage, and then we're gonna make a decision about how it proceeds from there.
I like this idea of not having a budget but a fund inside an organization. And when you see how the BC funds works, well, they, as you said, they invest in a lot of opportunities, but at the end, not all the opportunities actually return something.
Right.
So how does that dynamic work inside an organization?
Yeah, so I think it's an interesting thing. It's that when you're looking at it again, it's just it's not as simple as creating a budget where you take activity and divide budget. Like this activity is 2/3 takes 2/3 of the resource that this activity does, because we're moving from uncertainty to certainty.
Mm-hmm.
The one thing that we would do in a next fund and in a next cycle or discovery-driven development cycle and in a portfolio management approach, this is the intersection of these three things, is you're going to look at attrition rates. As I said, each stage of the next cycle actually has a different attrition rate that you need to decide. In formulate, how many opportunities do we think are going to move into incubate? From incubate, how many opportunities do we think will move into accelerate? Accelerate, how many will go into operate? And from operate, how many will go into grow? Now, you can decide, like, for example, it might be from formulate to incubate, maybe we're going to have a 66% attrition rate. That would get us from 50 to 17, right? So now I've got 17 going from incubate into accelerate. Maybe I'm going to have a 50% attrition rate there. So you need to factor that in, because what it says is the funds that I have available, that I've allocated for each stage of the cycle, are going to get distributed to the innovation opportunities, but they're not going to get distributed equally. Mm-hmm. You need to establish a funding benchmark, but you actually need a funding benchmark in each stage for opportunities that get promoted and for opportunities that get archived, right? So it's reasonable to think an opportunity that gets promoted from formulate to incubate or incubate to accelerate is going to use more funding than one that gets to a no at some point in the process, where we say, okay, we got to a reason on the Super 7 that we shouldn't keep going. It's not wanted, it's not doable, it's not worth it. It's not producing enough option value, right? It's not aligned with our vision because our purpose or our strategies have shifted. So you might get to a no. Well, that we're not going to expend all the capital on that. We're going to stop. We're going to get to a stop. We're going to high five everybody who got to a stop because they saved capital, and we're going to reassign them onto those other projects and opportunities that are moving forward. So again, the idea of a fund is to provide maximum flexibility for your next executives who are making these funding decisions. And what I need to know as a team is, hey, there's a benchmark. This is what this is the parameter or the sort of the lane that I'm operating in terms of funding. I might be able to ask for a little bit more. I might need a little bit less, but that's kind of the benchmark for this stage. If my idea is going to get promoted, but if I get to a stop, the sooner I can get to a stop, the better, because I'm saving that capital, and we factor that in. So if I've got 66% attrition in formulate, I might say I'm gonna budget $1,500 for the archived ideas. I'm going to budget $3,000 for the ones that move forward. So it's just a way of giving that kind of flexibility in terms of the process. So it feels a little bit abstract, but it's if you sit down and you do an annual plan for, hey, we've got a fund, how are we going to deploy this against these portfolios? You need to do that kind of work. You need to know sort of what are the guidelines, what are the guardrails that we're operating within. And I think the other thing that we hear a lot from clients is, well, we don't have a fund. Like, yeah, you don't. But I bet you if you go look at your budgets, your teams have put in budgets for new work. Right? So projects for next year, things that they're not currently doing. So you want to go and look at those and say, which of those actually qualify as innovation opportunities and ought to be moved over into our next system, and along with them, the funding. And we've actually had organizations that do that. They just take anything that's new, they push it over, and that's the fund. The other thing is, everybody's heard this, use it or lose it. So come October, come November, everybody's trying to spend their budget, because they know if they don't spend their budget, they're not going to get the same budget next year. In the next fund, that rolls over. So an investment fund doesn't go to zero because you reach the end of the year. Like, you put the capital in, you use the capital. If you have more capital available, it rolls over and you use it. into the next year. So a very different approach.
It's a different kind of logic.
Yeah.
Thank you so much. Thank you, Greg, and thank you, our listeners, for joining us to explore the transformative potential of Next funding. In our next episode, we'll go into the importance of Next tools. So now, go out and make Next happen.